Back in 2018, Kraft Heinz was the perfect value investment. Single-digit PE ratio, 6% dividend yield, 25% operating margin, all trading at below 1 price to book. And best of all, none other than Warren Buffett owned 27% of the company. Fast forward 12 months, and the stock had dropped 60%. At its worst, it was down 75% from its 2017 peak, and it's never really recovered. This seemingly incredible value investment became one of the worst investments of the decade. And an absolute textbook example of why value investing is so much harder than people think. I'm going to explain why and what to do instead. This story starts in 2015, when Kraft and Heinz, two separate companies, merged and became one, in part funded by Warren Buffett, who became 27% owner of the stock. The newly formed Kraft Heinz recorded around $105 billion worth of intangible assets on its balance sheet. They're things like brand names, trademarks, patents, things that have a value but you can't physically touch. And it's perfectly legitimate to add those to a balance sheet. They're important. These intangible assets included $44 billion of goodwill and $59 billion of trademarks, which made up to 87% of Kraft Heinz's assets. Following the merger, they aggressively cut costs, and they managed to push the operating margin up past 25%, which was amongst the highest in the entire packaged food industry. It made the company highly profitable, and it had a considerable boost in earnings per share, and thus the share price. But there was a big problem. Although these cuts initially made the company highly profitable, they were very damaging to the long-term health of the brand. They were no longer interested in investing in innovation, and they simply didn't keep up with shifting consumer preferences. In other words, the product was getting worse, and that has a lot more implications than you might think. Throughout 2018, those cracks started to appear and revenue growth had stalled. The stock experienced a 40% decline, but many of the underlying fundamentals, they still look strong. This was a very profitable business with low debt, an established name, and trading below price to book. Kraft Heinz was the textbook value investment. Out of favour with the market, yes, but with strong fundamentals and trading at below book value, which basically means it was trading below the value of all of its assets even after it had paid off its debts. It's a situation where you shouldn't be able to lose. And so a lot of investors at the time, they were excited about this opportunity, especially because they knew that Warren Buffett was an owner of the company. But then, very quickly, everything changed. In February 2019, Kraft Heinz announced a re-evaluation of its Kraft and Oscar Mayer brands. And because customers were now falling out of love with those products, the valuation of those brands were massively downgraded. Basically, overnight, Kraft Heinz's intangible asset value dropped by $15.4 billion. So it gets this huge drop in asset value, but then that also affects the debt position because suddenly the debt to equity levels increase. So assets have dropped and debt relative to the value of the business has increased. That's not great. But if that wasn't bad enough, the massive drop in asset value had to be recorded as an expense, directly affecting the company's income statement, their profit and loss. Essentially, those asset value reductions had to be recorded as a cost. As a result, Kraft Heinz, which recorded a profit of $11 billion the year before, fell into a $10 billion loss. And then things just got worse. The dividend was cut by 36%, and the SEC launched an investigation for questionable accounting practices. The stock plummeted, and it's never really come back. But as long as you weren't an investor, it's a good thing for us, because it is a perfect case study of the pitfalls of value investing, which can help us avoid the next Kraft Heinz. And it starts with understanding the crux of the issue. When people talk about value investing, they're often really talking about asset plays. Investments where the main attraction is you're supposedly buying something that's worth $1, but only for 50 cents. The idea is simple. If a company's shares trade at less than the value of its net assets, then you can't really lose. In theory, you could just buy the whole company, sell all its assets, use that to pay the debts off, and you'd still be left with more money than you started with. But there is a huge risk to this approach, which hardly anyone really talks about. Unlike daily traded assets like shares or bonds, most assets, like property or machinery or brand names, are not priced very frequently. Instead, companies estimate their value periodically, sometimes only once every few years. When they finally reevaluate them, there can be dramatic swings in price. Now, you might think that big price swings are quite rare, but think about this. The house you're sitting in right now, it's almost certainly not worth the same amount it was 5 years ago, right? Not even 3 years ago. In fact, the price of that house you're sitting in is probably changed in just the last 12 months. The exact same thing happens with businesses' assets. So often, new investors who want to take a deep value approach thinking it's safe, they place all their analysis on asset values. Things like the price to book or debt to equity, but there's a massive likelihood that those asset values are wrong, at least to some degree. And just to be clear, I'm not talking about fraud, I'm talking about genuine changes in asset value. The truth is, those asset valuations are often heavily based on a few assumptions, and if those assumptions are wrong, the consequences can be brutal. The trick to getting that kind of investment strategy to work is having genuine expertise in whatever type of assets they are that business owns. Again, as an example, the house you're in, you probably have a pretty good idea of how much it's worth. Likewise with all the houses in your neighborhood, if someone came along and offered 200 grand more than any of them were worth, you would probably know that they're overvaluing that property just because you know the area. You're like a mini expert. But if someone told you they were buying a 4-bed detached house for 300 grand in a random village, in a random country that you've never been to, you wouldn't know if that was overvalued, undervalued, or perfectly valued, would you? You wouldn't have a clue, neither would I. And you certainly wouldn't buy it without doing any research, would you? But people do that all the time trying to value invest. They often don't have a clue what the underlying value of the assets really is. They just take the balance sheet at face value, and that, as we've seen, can end in disaster. The real trick to that kind of investing is knowing whether the actual value of the assets is lower, higher, or exactly what's reported on the balance sheet. If you think the assets are worth more than being reported, well, that'll likely get revealed at the next reevaluation of the assets, and then the share price will correct accordingly. But having that kind of knowledge is very skilled and very difficult. It's not a great approach for most home investors. And it's why true value investing is so much more difficult than people think it is, because when you get it wrong, you get slaughtered. So let me show you what I do instead. And I want to bring Warren back into the discussion here, because everyone calls this guy a value investor, and he is, to some extent. But he hasn't practiced deep value investing since the 1950s. That's when he was focused on things like price to book. But what Buffett really does now, by his own admission, is just find great businesses. He does value them to make sure he's not paying over the odds, but his sole aim isn't to find deeply undervalued stocks and wait for a correction. He simply finds great businesses and makes sure they're not overvalued. And if they're undervalued, well, yeah, that's a bonus. So unless you have some specialist knowledge of how to value a certain type of asset, I would strongly advise you not to base your investment decisions on things like price to book. Just because price to book is below 1, it does not make it a safe investment. But here's 3 measures I use to help ensure an investment is reasonably safe. And this first one would have stopped you buying Kraft Heinz at all. And if you did own shares, you'd have sold them way before the price actually dropped, because that company hadn't grown its sales for 2 years before the share price finally collapsed. Regular viewers will know I like to be a customer of the companies I invest in, because then you know the product is getting worse before it's ever shown in the financials. And if a product or service is getting worse long term, that is never a good thing for the share price. But let's say you weren't a Kraft Heinz customer. The signs were still there, because the actual customers were buying less each year than they did the previous year. I always want to see a business increasing its sales year on year, and I set a minimum threshold for my investments of 50% total sales growth for the last 5 years. Those of you who use my stock screener, if you don't, check it out, it's totally free, will know that the strategies I focus on, the lower and balanced risk ones, both have a 50% sales growth threshold. You could set a lower threshold if you want, but a decline in sales is a very big red flag. I also want to see a strong free cash flow position. It often paints a better picture than earnings does of how much money that business is really making at that current moment. Net profits can be misleading. For example, a company might report as being profitable for a given year, but when you look, you might actually see that the cash flow is negative. That could be a big problem, because it means that the company is spending more money than it's keeping. And it can't do that forever. It's not sustainable. So I always want to make sure my investments are free cash flow positive, which simply means that they bring more money in than goes out. And I like to compare that figure to rivals in the industry to make sure it's at least similar, ideally higher. Because when a business has to innovate or change a product to meet shifting consumer demand, they need that cash to do it. Otherwise, they'll probably have to raise debt, which is a bad thing. And talking of debt, my last measures are all about assessing that debt risk. So first off, I like my investments to have a debt to equity level of 0.5 or less. The reason I like it so low is because of exactly what I've talked about in this video. I know the valuation of some of those assets could be wrong, but a debt to equity level of 0.5, it gives me some buffer before that debt starts to look scary. However, there is another level I use to assess the debt, because there is a type of asset that you can compare against debt that isn't going to change much. Cash. The value of a company's cash reserves is never going to drop 30% overnight, assuming it's not in some dodgy currency. So you can compare the business's cash reserves and its marketable securities, which are basically assets that they can sell very, very quickly, things like bonds and shares in other publicly traded companies, against its long-term debt. If a business already has the cash on hand to clear its long-term debts or close to it, then it's in a super safe position. Checking those three things, in my opinion, is a much better way of finding a safe investment than looking at the price to book. But you will still need to value the stock. And I think identifying overvalued stocks is actually a much more important skill than identifying undervalued ones. So watch this video for a full guide on how to identify overvalued stocks so you don't get destroyed by market hype.